The live intraday market price for Nokia stock, trading under the ticker NOK on the New York Stock Exchange, is currently sitting at $16.46 per share, showing an aggressive upward movement of 6.4% in this session alone on immense trading volume. Most retail traders looking at this price action think they are looking at a dead telecom hardware company suddenly getting caught up in a random meme pump. The reality is that institutional capital is silently moving into this asset because Nokia stock is quietly transformed into an essential back-end supplier for massive artificial intelligence deployments and global enterprise data routing. Right now, major financial firms are tracking the company's unexpected dominance in high-speed optical data connections, a sector that surged 20% in their recent financial reports. This structural shift has caught short sellers completely off guard, driving the valuation to heights not seen in 15 years and fundamentally altering the supply chain landscape for global data infrastructure. When you think about Nokia stock, your mind probably flashes back to indestructible blue brick phones from 25 years ago, or maybe a struggling European hardware maker that completely lost the smartphone race to Apple stock. That is the common narrative, and it is exactly why the broader public missed a massive 154% move over the last 12 months. The average person using modern retail apps like the Robinhood app or browsing casual investing sites assumes Nokia is a relic of the past, stuck in a low-margin cycle of building cell towers. But if you look under the hood using a more advanced individual brokerage setup like the Interactive Brokers platform, you see an entirely different corporate entity. Capital is moving aggressively because the company just raised its annual growth expectations for network infrastructure to a massive range of 12% to 14%. While retail money was busy chasing volatile hype cycles, sophisticated funds utilizing automated options order flows and institutional individual brokerage accounts were quietly accumulating shares under $5 last year. The real narrative driving the recent daily swings is the massive spending mismatch between what massive technology giants are investing and who actually builds the physical pipes. To understand the momentum, look at the staggering numbers from their first quarter report. Net sales to cloud and machine learning infrastructure providers skyrocketed by 49% year over year, now accounting for a crucial 8% of total group sales. This is not a temporary trend, it is a structural transformation in how data centers talk to each other. When mega-cap tech entities scale up their processing clusters, the physical limitations of copper wire create immense bottlenecks. This requires a complete overhaul of fiber optic routing and switching systems. This structural shift is precisely why Wall Street institutions using advanced fidelity trading platform tools are shifting capital away from legacy chip companies and directly into the hardware layers that connect those chips. This structural shift is what forced major investment banks like Morgan Stanley to aggressively hike their target price to €14, sparking a massive wave of buying across retail and institutional brokerages alike. If we look at the pure volume trends, the regular daily trading activity has occasionally surged past 100 million shares, revealing an intense accumulation phase by large institutional players. If you pull up the historical charts on the Robinhood stock trading interface, you will see a massive breakout pattern that completely shattered the multi-year resistance levels near $8. This massive move was validated by an expansion in comparable gross margins, which expanded by 320 basis points to hit a healthy 45.5%. When a hardware company increases its pricing power while simultaneously increasing its sales volume, it means they possess proprietary tech that the market desperately needs. Nokia recently introduced a next-generation multi-rail inline amplifier that delivers an 8 times increase in optical density compared to traditional configurations, while being 25% more dense than anything their competitors have announced. In plain terms, they can pack 8 times more data through existing fiber infrastructure without forcing telecom operators to dig up streets to lay new cables. This specific piece of engineering explains why their optical networks division is suddenly growing at a 20% clip, completely crushing initial internal forecasts. Let's pause for a second to gauge the community sentiment on this massive turnaround. Comment below how many shares of Nokia stock you currently hold in your portfolio, or if you prefer sticking to broader baskets like Fidelity ETFs instead. To map out how this connects to the broader market, we have to look at how retail capital interacts with these trends. If you are handling online investing through automated platforms like Schwab Intelligent Portfolios or using a basic individual brokerage account, your automated systems might flag Nokia as an overvalued stock based on its trailing price-to-earnings ratio, which currently hovers near a steep 97 times earnings. But a trailing valuation metric is backward-looking. It fails to capture the massive cash generation happening right now. During the last quarter, Nokia generated a robust €629 million in pure free cash flow, lifting its total net cash balance to a pristine €3.8 billion. This clean balance sheet is a massive competitive advantage when interest rates remain restrictive globally. While smaller competitors are struggling with high interest expenses on their corporate debt, Nokia is actually generating positive financial income from its cash reserves, raising their full-year financial income guidance to a positive €150 million to €250 million. This brings us to the actual business model, the core fundamentals that support this massive multi-billion-dollar framework. Nokia operates through 4 primary business segments: network infrastructure, mobile infrastructure, Nokia Technologies, and their emerging cloud and network services. The segment that everyone used to worry about was mobile infrastructure, which primarily deals with selling 5G radio towers to global telecom operators. For years, this was a brutal, low-margin price war against companies like Ericsson and Huawei. Telecom capital expenditure has been notoriously weak as global service providers realized that consumers would not pay a massive premium just for faster 5G download speeds on their phones. This weakness caused Nokia's revenue to slide
worldwide over consecutive years, dropping from over 26 billion euros down to roughly 20 billion euros by the end of last year. This historical drag is the exact reality that shaped the negative market expectations. Investors saw a shrinking telecom supplier and walked away. However, the reality of the business model has fundamentally decoupled from the legacy telecom cycle. The company has aggressively pivoted its fixed networks division away from low-margin consumer fiber rollouts and directly towards high-margin enterprise data products. Their Nokia Technologies division operates as a highly lucrative licensing house, extracting steady royalties from consumer electronics, automotive manufacturers, and multimedia brands. In the recent quarter, this licensing business generated 385 million euros, growing 10% on a constant currency basis due to new long-term agreements. This structural mix creates a highly efficient cash engine. The steady, recurrent licensing fees act as a defensive buffer, while the booming data center infrastructure business provides the high growth upside. This explains why the overall operating margin expanded by 200 basis points to 6.2%, tracking well ahead of management's original internal models. If you are using basic self-investing tools, online investing sites, or keeping track of your long-term wealth through Fidelity Mutual Funds and Fidelity Iris, the crucial thing to evaluate is the forward-looking catalyst map versus the inherent structural risks. The primary growth catalyst over the next 18 months is the integration of their recent Infinera acquisition, which is already creating massive supply chain efficiencies in their optical business. This acquisition allows Nokia to sell complete end-to-end RANing architectures directly to North American web-scale cloud operators, completely bypassing traditional carrier intermediaries. Geographically, this strategy is already paying massive dividends. Sales in the Americas region grew steadily to 1.54 billion euros, helping offset persistent macroeconomic weakness in the Asia-Pacific region, where regional spending slowed down significantly. Yet, the tension between expectation and reality cuts both ways, and there are very real structural risks that could derail this massive turnaround. The most pressing risk is the steep valuation multiple the market has suddenly assigned to Nokia stock. At 97 times trailing earnings, the market is pricing in absolute perfection for the upcoming quarters. If the sequential net sales growth for the next quarter falls even slightly below the projected 5 to 9% management forecast, the institutional algorithms that drove this massive price breakout will unwind their positions just as quickly. Furthermore, while their enterprise business is booming, their core mobile infrastructure business still accounts for 2.5 billion euros of quarterly revenue. If global telecom spending experiences a second leg down, or if major carriers continue to defer their network upgrades, that legacy drag could easily swallow up the margin gains achieved by the booming AI and cloud routing business. When you evaluate your portfolio options across diverse investing sites, whether you prefer the active trading tools on the SoFi trading platform, the automated balance of a SoFi robo-advisor, or manually managing assets in a Fidelity brokerage account, Nokia presents a fascinating case study in narrative shifting. The market spent years treating this asset as a dead legacy hardware company, assigning it a depressed valuation that completely ignored its underlying intellectual property and liquid balance sheet. Now the pendulum has swung aggressively to the other extreme, with the stock hitting a 15-year high as it gets reassessed as a critical structural play for cloud infrastructure. Ultimately, the central insight here is that the physical layer of the web matters just as much as the software layers built on top of it. The market's original expectation was that Nokia was a structural loser trapped in a declining telecom hardware market. The reality is that their specialized optical switches and high-density amplifiers have made them an indispensable toll collector on the global data highway. This stark contrast between past perception and current operational execution is exactly why the stock has experienced such an aggressive re-rating. As you monitor the subsequent trading sessions on your individual brokerage apps, remember that the companies providing the physical connections often hold the real structural power when data demands explode globally. Keep a close eye on the sequential margin trends in the upcoming quarters, as that data will ultimately dictate whether this spectacular turnaround can sustain its momentum or if the market got ahead of itself. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.